Looks like it could, I mean, who knows where the polls are? We'll find out on the 23rd of June. How big of a risk is this?
Well, I think it is a risk, not necessarily because the UK might leave the EU, but it's a risk in terms of the follow-on that others might think of the same example, that France, by the way, or Italy might suddenly decide that their own domestic internal policies, should be favored versus that of a larger EU family. And so, if Brexit wins, then fear gets into the marketplace and positions in terms of expectations for growth, anemic as it is in Euroland, become threatened.
Well, so according to this poll, it is a real possibility. So your job is to anticipate and invest about what might happen or is likely to happen in the future. So when you look at the possibility of a Brexit or an EU dissolution of some kind, and of course that's a decade-long proposition, how are you or how should you or how will you invest around that?
Well, this is just one additional element that does not favor risk assets, because risk assets are dependent upon growth. They're dependent upon, even in the high-yield market, on relative stability. And to the extent, from a geopolitical standpoint, that growth is threatened, then risk assets are at risk. And of course, currencies, we just saw that the pound was much weaker. There are hundreds of billions of positions, that hedge against these possibilities. And as one becomes more probable than the other, then money moves quickly and causes volatility and instability. So all of that is...
But it's interesting, though, because the German, and I don't want to get too deep in the woods on Bunds and JGBs, but, the German government bonds are yielding nothing, negative, actually, on the short term. Right. So people are still buying them despite these risks. How do you square that?
Well,
or who's buying
to a certain extent, they have to. And to get back to treasuries are the flight to quality asset. I would think, I don't know, but in the last 5 to 10 minutes, based on this poll, the treasuries are doing better and stocks are doing worse. Why do people buy German Bunds at a minus 25 basis points? People don't. Banks do, because they must invest somewhere. And so in this finance-based economy, the alternative is cash, and there's just not enough vault space to store cash, and so they invest where they can on an electronic type of basis.
Does what's happening in Japan and does what's happening potentially in England and the EU make U.S. assets, equities, treasuries, corporate bonds more or less attractive?
More attractive. For instance, in Japan, which I think is the nexus of the last 2 or 3 week bull market rally in treasuries, their 30-year bond has moved down by 20 basis points. It's now at 28 basis points. And so the Japanese basically say, well, a 30-year treasury at 250 plus the possibility that the dollar itself strengthens, that's a double play for them. And so U.S. treasuries benefit from these lower interest rates in Japan and elsewhere.
And to wrap it up, we think of you as the bond king, but with the unconstrained fund, the word means you can kind of do what you want. You and I spoke earlier. You like certain mortgage REITs, like an Annaly Capital, correct?
Yes. And the reason is that these are near banks. They don't carry FDIC insurance.
NLY, the ticker on that,
deposits.
if my brain serves me
NLY
right.
is the ticker. They're near banks. They're levered 6 times. Banks are levered 8, 9, 10 times, so actually they're less levered. They invest in government-guaranteed assets, but the risk is that interest rates, short-term interest rates and prepayments will, disturb the mix. So these aren't riskless investments, but they do carry an 11% yield, and in this day and age, I think that's an attractive return relative to the risk.